It's been this desire of people, not just investors, but people, to understand how their lives are about to change. And I mean change radically. And actually, a margin miss is actually for us a good thing. Because what does it usually mean? It means a company has decided to invest aggressively now to capitalize on this opportunity. And we think that's the right thing to do. Those who are not investing aggressively enough, who are buying back their shares, leveraging their balance sheets, paying dividends, leveraging their balance sheets, they are going to be the losers.
Have a great day and welcome to my channel. As you can see, in today's episode we are focusing on a remarkable interview with the CEO of ARK Invest, Cathie Wood. During the interview, Wood was asked about current market conditions, her thoughts on the Reddit community, disruptive innovation, and how her team decides when to sell an asset. She regularly points out how important research is. ARK's investment cases are based on this research. But now, let's listen to her response.
What's fascinating about this period is that now we're seeing a flood of IPOs, a flood of secondaries. We've seen SPACs, which really are liquidity events earlier than might otherwise have taken place, because I think there's a collective understanding that the future is here. And if we don't invest now, we're going to lose out. So sure, while we scaled really sixfold last year, and that's much faster than the technologies that we are researching, how fast they're scaling. But they're starting to scale pretty quickly collectively. So we've got 5 platforms, 14 different technologies. We've never seen this amount of change at the same time in history. So we think there's going to be a lot of capacity for innovation-oriented investors out there. Well, I find it very interesting. I've been looking at millennials in the workforce, or we've been looking. So it looks like a third of the workforce is millennials, and that's going to 75%. I started in the business in the 80s when the baby boomers were coming of age. And there was a strategist, Stan Selvigsen, Merrill Lynch, may he rest in peace. He drew expectations for demographics, baby boomers as a share of the workforce. And what happened was he believed that meant they'd be much more attracted to equities and that they would drive equities up. Now, here we are, the millennials are going from 33% of the workforce now to 75%. There's a tremendous intergenerational wealth transfer, the biggest we've ever seen in history. So they're going to control a lot more than even the baby boomers did at the time. And I think it means positive, that there are positive ramifications for both the equity markets and the crypto markets, both of which millennials have taken, in which many have taken an interest. So the GameStop and the let's get the hedge funds. One of the interesting things about this is they're actually aiding and abetting, and I don't think you've heard this anywhere else. They're aiding and abetting the bond bubble. What is happening? What is happening? These companies that are left for dead by innovation, by the way, are selling, some of their bonds are selling at 25 cents on the dollar. they're dead as doornails in many, even bond investors' eyes. Once you drop below 75 on a bond, 75 cents to the dollar, the risk of bankruptcy looms large. So now some of these companies are refinancing. They're actually accessing the equity markets. They're not refinancing their debt. They're right now, they will. They're accessing the equity markets, and their bond prices are skyrocketing. They're tripling. I think it was AMC. Their bond price has just gone from 25 cents to 75 cents. Now, if you ask me, a student of innovation, maybe there's a shot of survival here, and maybe more so now that they've been able to do an equity offering, which they could not have done 2 weeks ago. Maybe, but I would not be putting my money there. I want to be on the right side of change. That's what ARK is all about. Well, we're looking because if we're right, this market is going to go from 2.2 million sales, that's units, in 2020, it might be 2.3, to 40 million in 2025. So all of these announcements have increased our confidence that the capital markets are going to finance this transition from internal combustion engine to electric. That's great. Who is going to be leading the charge, so to speak? We still think it is Tesla, certainly in the United States. Even in China, Tesla is the #1 brand. Now, the smaller vehicles in China, there is a company, I've forgotten its name. It might be associated with SAIC and GM, by the way, that is pulling ahead. But that's not counted as a true electric vehicle. These are the ones that go 25 miles an hour, golf cart types of things. So we think that China might hold the secret as to the next big winners. We know that NIO, we do not own NIO. It's a battery swapping company. So instead of charging, they swap batteries. That is going to win the day. We think that XPeng, which we do not own, but which is emulating Tesla, might. We're seeing, and we do own in our more specialized strategies, BYD was a battery manufacturer to begin with, and Warren Buffett has owned for many years a piece of BYD. That has done very well. We own that. And then Geely, which bought Volvo, and I believe the chairman of Geely owns a position in Daimler. It is also doing a lot of interesting things in terms of partnering with various companies, including Baidu. So if I had to give you which of the Chinese names we have the highest conviction in, it's probably Baidu. And that had been a hard sell for me because their search business was falling apart. And it did seem to me, with more than 150 or 200 electric vehicle manufacturers, many being government subsidized, that there would be a bloodbath. And Baidu is, the government has deemed it the autonomous platform for China. We weren't sure whether to believe that or not, or if it would get caught up in the carnage, but it does seem to be doing something very interesting. And there's also another company called AutoX. This is more, they're working with Dongfeng, which is mostly involved in the trucking space. But we did take note that AutoX has gotten approval from California to go fully autonomous there. I didn't know that until very recently, so that could be another one to watch. We do not agree with that. And what's been interesting this time around is if you look at Google search trends for Bitcoin or Bitcoin's price, against the Bitcoin price itself, you'll find that there's not a lot of speculative activity by that measure. In fact, in 2017, they were 1-for-1 together, but it has been pretty quiescent until maybe very recently, but throughout last year. And so that gave us a lot of comfort. We believe that the institutional behavior and moves recently have been fascinating. We have been expecting institutions to start moving into Bitcoin and other crypto assets, but primarily Bitcoin, the most secure of the blockchains, because if you look at the correlation of Bitcoin's performance relative to any other asset class, it has the lowest correlation, meaning if you buy some Bitcoin, you will further diversify your portfolio and increase your returns with lower risk, right? So that's why institutions look for that low correlation. Bitcoin has it. But what surprised me and us generally was to watch MicroStrategy, which has put all the cash on its balance sheet into Bitcoin, and even did another equity offering so it could put more cash on its balance sheet. And I think that's a little crazy, because I think the regulators will have something to say about this in terms of what is this? Is this company the MicroStrategy technology company, or is it like an ETF? So we don't know about that. But then you saw Square put 1% of all of its assets in Bitcoin. And I think you're going to see more of that. We didn't expect that. What we did expect was, because of the low correlation of returns, institutional investors to move in. The most surprising one to me thus far has been MassMutual. It put $100 million into its general account. Now, its general account is enormous. So $100 million is something like 0.001. But what that move told us is, MassMutual is very conservative and very highly regulated. And so it had to jump through many more regulatory hurdles than I thought would have been possible by now. So I think that is a seal of approval. And then, of course, you have the institutional infrastructure moving into place, whether it's with custody, and everyone knows a lot about Fidelity being out there in terms of wanting to custody Bitcoin in particular. You have the Intercontinental Exchange, and you've got the CME now with Bitcoin futures, one settling in kind, one settling in cash. And so we do believe that Bitcoin is getting ready for institutional, but Bitcoin is it's roughly a $600 billion market cap. So not even half the size of Apple or Amazon, right?
Yep.
Doesn't put it into perspective. And yet it is a very big idea. I think a much bigger idea than Apple or Amazon. It's the first truly global digital currency out there. And it is completely decentralized. There's no throat to choke. So unlike with Libra, you had Europe and the US and many countries saying, we'll never allow this. That's because there was one throat to choke. With Bitcoin, there's no throat to choke. And in fact, when China basically shut down the exchanges in China that dealt in crypto, especially Bitcoin, that activity just moved over to Japan, Thailand, and Korea, other countries that wanted to move ahead in this innovation space. They did not want to miss this next big thing. Yes. Well, we have a very disciplined process. And so our minimum hurdle rate of return for a stock to enter the portfolio is 15% at a compound annual rate over 5 years. We expect the stocks in our portfolio to double over the next 5 years. Now, when you have big runs, as we did last year, a lot of stocks drop below that 15% as a 5-year expectation. And so when they drop into the 10 to 15%, we'll be taking profits. So we are selling if they're core to our platforms. Then we will probably sell, if we think it's gotten way out of hand, we'll sell it down to 50 basis points. We've gone from 10% to 50 basis points in stocks and exiting some as well. Even if they are core, we just think, okay, they're going to need a long time to grow into this valuation. And we don't want to live with or sit with dead money. But then we will get corrections like the coronavirus, right? And what we do during a correction, we will have sold stocks that are core. For example, 2U and Teladoc are they were in both our next generation internet portfolio and our flagship before the coronavirus. Both of them benefited from stay at home. They started moving up as other of our stocks were crashing. They moved up to such a point, they dropped below the 15% as these others were giving us opportunities to deliver 50% plus at a compound annual rate. That's at the beginning of last year. At the beginning of last year, that number, that 5-year number was 42%. Today it's closer to 20%. But stock by stock, we're looking at that 15%. And the more it falls below, the more profits we will take. So we have such a creative research team, however, and there are so many stocks vying for our attention and with these IPOs, vying for a position in our portfolios that when a stock drops below 15%, we know there's something else waiting, knocking at our door, waiting to get in. Question, are we in a bubble? I do not believe so. And I am very happy that many people are worrying that we're in a bubble. I experienced the late 90s bubble, and yeah, the value investors out there were really worried, and they think they're going to have their day in the sun again because they did so well during the tech and telecom bust. I don't think that's the case now. I think that the seeds for what we're experiencing now were planted back then. Too much capital chased those opportunities too soon after too few opportunities. There were too few opportunities and the technologies weren't right. The costs were way too high. We're at prime time for those 5 platforms now and those 14 technologies. And we've just begun. And they're going to be very disruptive and maybe destructive to a lot of value spaces. Not everyone, but anyone looking at price to book, watch out for that book. It may disappear because of disruptive innovation. Anyone looking at that high dividend yield saying, I got to hold on to the stock, be suspicious of high dividend yields if that company is in harm's way. And I would say there's about 50% of the S&P 500 in harm's way.